Welcome to the deep dive. We're here to give you that shortcut, to being really well informed without drowning in information. Our goal is always to cut through all that noise, find the important nuggets, and make complex stuff clear, maybe even, captivating. Today we're diving into something a lot of investors are interested in, the so-called reliable dividend stocks that look like they might be on sale right now. We're drawing from some excerpts titled Reliable Dividend Stocks, Buy Now or Double Up. And this piece really zeroes in on a few specific companies. High yields, solid businesses, maybe a real opportunity.
Exactly. And our mission here is to unpack why. Why these stocks, what's behind the reliable dividend claim, and importantly, what does on sale actually mean in this context? We want to give you some clear insights, really, whether you're just starting out or maybe thinking about adding to positions you already hold. So let's get into it.
Okay, so where do we start this hunt? First up is a company often called the net-lease king. That's Realty Income, ticker O on the NYSE. When they say it's big, they mean it. It's the largest net lease REIT that's a real estate investment trust.
Right. Companies owning income-producing real estate.
And Realty Income is, get this, more than 3 times the size of its nearest competitor. Huge scale. And net lease, just quickly, means the tenants pay most of the property operating costs. That's pretty central to their model.
It really is. And that size, combined with what the source calls an investment grade rated balance sheet, well, that's powerful. It gives them, better access to capital markets. Basically, they can borrow money more cheaply than others.
Oh, okay. So a lower cost of capital.
Precisely. Which means they can be really aggressive when buying properties. They can do deals, big acquisitions even, that smaller players just can't manage. They can really act as an industry consolidator because of that scale. It's a significant advantage.
That makes sense. A strong competitive edge. But I guess with that kind of size, growth might be more steady than explosive.
That's generally the expectation, yes. Slow and steady is likely the norm.
But you combine that stability with a, 5.6% dividend yield right now. And that dividend has been increased every year for 30 years. 3 decades. That's consistency.
That's why income investors really like it, right? You see the $51 billion market cap, the price around $56, but still a solid gross margin near 48%. It screams stability, even if it's supposedly on sale.
It does paint a picture of a very solid operation.
Okay, so Realty Income offers that rock-solid stability. But what if you're looking for reliability, but maybe, just maybe, a bit more growth potential coming out of a temporary dip?
Good question. That brings us neatly to our second company, PepsiCo. Ticker Pay.
Right, the consumer staples giant. Everyone knows Pepsi, but they're more than just drinks, aren't they?
Oh, much more. One of the biggest beverage makers, sure, but also the most important salty snack maker globally with Frito-Lay.
Ah, Frito-Lay, right.
And they've got a significant packaged food business, too, like Quaker Oats. So a real powerhouse across the board. Distribution, marketing, R&D. They can compete with anyone.
Absolutely. But the source points out even giants like PepsiCo sometimes, they muddle through, as it puts it. They hit slow patches.
And that's happening now?
Seems like it. They're muddling through again. And that temporary struggle is why the stock currently has a yield around 4%, which is historically quite high for PepsiCo.
So that's the on-sale signal again. The higher than usual yield.
That's the idea, because look at the track record. PepsiCo is a dividend king.
Wow. King status.
Meaning over 50 years, 5 decades of consecutive annual dividend increases. You just don't build a record like that by accident,
No, that takes serious resilience.
Right. And management isn't just waiting it out. They're buying brands, investing in new products, refocusing operations. The usual playbook to get back on track. The expectation is they'll return to growth soon enough. They've done it many times before.
Okay, but when you hear muddling through, some people might worry, right? How do we know it's temporary? I mean, it's a $191 billion company, price around 139ers, gross margin over 54%, fundamentally strong, looks like. But still.
That's a very fair point. No guarantees in investing, of course. But with PepsiCo, that long, long history of dividend growth isn't just a number, it's evidence. Evidence of navigating recessions, changing tastes, competition. They've seen it all. The current actions fit their pattern for recovery. So for someone investing long-term, this kind of phase is often seen as the opportunity, the entry point.
Got it. Buying quality when it's temporarily out of favor. All right, that's 2. Our third company today is Medtronic, ticker MDT, a big player in medical devices. Now, the yield here is lower, around 3%.
Correct.
And this is the key part, the 3% is actually historically high for Medtronic.
Bingo, another on-sale signal potentially. It looks relatively cheap compared to its own history.
So why might it be on sale, and what's the potential catalyst for it to shine again?
Well, the source highlights a few really interesting things coming up for Medtronic. Big things, potentially. First, that dividend streak. It's currently at 48 years.
48. So very close.
Very close. Just 2 more years, and they joined that elite Dividend King club alongside PepsiCo. That's a huge milestone Wall Street notices.
Okay, what else?
Second, they apparently went through a bit of a dry spell with new products, but now they're launching new stuff again. Things expected to really add to growth.
New product cycle kicking in.
Seems like it. And third, they're actively reshaping their business portfolio, focusing on higher margin areas. A big part of that is spinning off their lower margin diabetes division planned for 2026.
Ah, shedding a less profitable part.
Exactly. And that's expected to boost overall company profits pretty much immediately after it happens.
So putting it all together, it's this huge $114 billion market cap company trading around $89, strong gross margin near 60%, but maybe it's been a bit unloved. And now there are these potential positive shifts starting to happen.
That's the narrative, precisely. An unloved healthcare giant, as the source puts it, that could be getting ready for a comeback.
And the market maybe hasn't fully priced that potential in yet.
That's the argument. The market can be slow to recognize these turning points, especially in massive companies, and that's where the on-sale idea comes from. It's an opportunity for investors who see the potential early.
Okay, interesting. So let's pull back for a second.
Yeah.
We've looked at 3 companies: Realty Income, the REIT King, PepsiCo, the consumer giant working through a slow patch,
Right.
and Medtronic, the medical device maker, with potential catalysts on the horizon. What's striking is none of these are obscure little companies, are they? They're household names, established leaders.
Not at all. These are giants in their fields. And the common thread, the thing that ties them together in this discussion, is that characteristic we keep mentioning: historically high dividend yields relative to their own past levels.
Right. The yield is the signal.
It's the signal that suggests they might be on sale or relatively cheap right now. The market might be focusing elsewhere, maybe on faster growth stories, and overlooking the underlying quality here. And that can create these compelling moments for you, the listener, whether you're thinking about starting a position or, as the source suggests, maybe even doubling up if you already own them.
So to recap, we've explored how these 3 very different but reliable businesses seem to be offering interesting entry points right now, largely because of market perception or temporary headwinds making them look on sale.
And just to hammer home a point from the source material, especially regarding Medtronic, the suggestion was, you might want to consider buying before Wall Street fully catches on to these positive trends taking shape. And more generally, for all 3, the idea was to strongly consider adding to positions now while they still appear relatively inexpensive compared to their potential.
It really brings up a fascinating question for you to think about after this deep dive. How do you develop that skill, that ability to spot genuine value when a fundamentally strong company is just, muddling through or seems unloved by the market? How do you recognize that underlying strength and potential before everyone else does? Something to definitely chew on.